All right, well, I have some questions for you then. At the end of the first learning objective, let me bring that to you, sorry about that. All right, so from the first learning objective, I'm not necessarily going to ask this question, but you should know this. So you should know that when a corporation uses straight line, the amount of depreciation expense will be reduced from year to year. No, straight line is constant depreciation. So that answer is false. The first one is false. Now, here's a theoretical question, and again, you have to realize that the exams are split 50-50 between theory. Some of those theory questions, I have to admit, are definitions, but they're split theory and practice or theory and problem. So here's an example of a question that I'm going to ask you, Channel 74, of course, as you can see. So let's get your opinion on this one, or at least your answer. Which of the following accounting principles requires that a company record depreciation? What's the closest or the best answer to that? That's the third. I'm going to go back to the other one. I realize I skipped it. Okay, that's the third question. Okay. All right, so, yep, it is matching. So the matching concept is the appropriate answer. And again, this one was relatively easy, but once again, make sure you realize that all of the concepts, and I was mentioning this during office hours today, it is very possible that you could take any one of those concepts and find a way to relate it to depreciation. You have to take the one that is best related, the one that is best related. All right, the next one, I'm going to go back. I know I skipped this one. I definitely want you to answer this question. When an asset is fully depreciated, then the residual value must be written off. True or false? Okay. All right, come on is right. It's got to be false. All right, that is not true. The residual value, when an asset is fully depreciated, when there's a scrap value, the term fully depreciated means it's left with the scrap value. That's exactly, in other words, you stop depreciating it, but the scrap value could remain on the books. You could still use an asset if it's fully depreciated, meaning that all that's on its books is its scrap value. You could still use it. If the scrap value is zero, you could still use the asset. Yeah, Anthony?
What happens to an asset when you write it off?
If you write off the asset, it would result, in this case, with a loss, because what will happen is you're scrapping it, but there's still some value remaining. So that's when you would experience the loss. But we're going to get to the disposals in a minute.
Professor, but you mentioned cost and then one of them gets written off. You
mentioned, because you said that one of them gets written off, and then the scrap value?
Yeah. So, yeah, when you depreciate the asset fully, it could have a scrap value. They call it the scrap value. Yeah, it's part of the process, right? We'll talk about that a little further. Okay. All right, so let's try this one. Now, somebody was telling me that, hey, I don't know if a minute is enough to do these calculations. One of the things, we had a meeting yesterday, talking about the class, how it's going, and it seems that people don't read the course outline. So go back there, read the course outline, and it says that you've got the questions, you should kind of look at them before you get here. So I would expect you to be able to do something like this in a minute. I guess on an exam, it might be a little bit more than a minute, but let's try it. I want you to give me the straight line depreciation expense per year. This should be easy. We'll see. Everybody's got to get this one right. All right. Almost everybody got it right. All right, so the answer is 190. The answer is 190. All right, so again, since some people got it wrong, I will spend at least another few seconds on this thing. All right, so you have to take cost minus the estimated scrap value over the estimated life. And this is known, again, as depreciable cost. So in this case, the cost was $1 million. And the estimated scrap is 50, and it's a 5-year or a 20% rate of depreciation. The depreciable cost is $950, and the annual depreciation is $190 per year. So the answer is B. Okay, again, exam. Perfectly acceptable question that you could expect. All right, any other questions? Any questions on that one? So you should be getting that question right. That's an easy question. So make sure you understand straight line. All right. Let's do at least one more. I want to go to declining balance depreciation. That's the last question. So in this one, the asset cost $1 million. There's $100,000 residual. Life is 4 years. I want the depreciation in the first year using double declining balance. Okay, here we go. Ooh. Okay. Now, if the answer is B, and that's a problem because more people answered A. If you answered A, what you probably did was deducted the scrap value, correct? Yeah. There's no scrap value in declining balance. So under declining balance methods, you do not use the scrap value. Basically, let me, might as well use my own notes on this one, it will go faster. All right. Moving that down a little bit. So the first thing you got to do, the first thing you have to do is calculate the straight line rate, which is 25%. Double declining balance is twice the straight line rate, so it's 50%, and you don't use depreciable cost. The basis for double declining balance is not depreciable cost, it is book value. This is the net book value. Cost minus accumulated is the beginning net book value. I'll make that a little small. So it's the beginning net book value. You do not use scrap value. So in year one, you multiply that out. The beginning net book value is, let me try to straighten that out for you. Beginning net book value is $1 million. Multiply that by 50%, and you get your double declining balance depreciation of 500.
Is this for the first year?
First year.
I'm sorry, it doesn't feel like, does that go to that, but then if I were to do that, it would be from the beginning. Just
Yeah.
For the first year.
The question is it the first year? Double declining balance, if you look at the table that I gave you, the last thing we did, and again, we're going to try to keep it quiet at the end of the class today, hopefully, but normally the last few things I say will be on the exam, but people are getting ups, landing books, and sometimes people miss things. So definitely the last table I did was a double declining balance table, and that table showed you that you have to look at the beginning balance of the net book value. Even though the depreciation is recorded at the end of the year, it is a function of the beginning net book value.
So the almost minus 0?
No, because that's only the beginning of the first year that it's minus 0. What's the book value at the beginning of year 2? It's going to be 1 million minus what? 500,000. So when you go into the second year, if you wanted to do this for the second year now, so what you would see is for the second year, you'd have cost, this for year 2. See if I'm on the, it's cost minus accumulated. And that would be 1 million minus the 500,000 you just calculated. So the net book value at the beginning of year 2 is 950. Right, since you've already depreciated 500 from last year. So you always take, when you do year 2 depreciation, you always do the 500,000. I'm sorry. It's 500,000, right? Sorry about that. Right. Okay. So it's always going to be the cost minus the accumulated depreciation. Sorry about that. Yeah. So it's 500,000 left, and the depreciation would be 50% of that, or 250. So the depreciation would be 50% of that, or 250. So the year 2 depreciation would be 250,000. Okay? So you always take it as at the beginning of the year. So double declining balance takes a constant rate. It's a 50% rate on the beginning net book value. So it's always the beginning of the year. It's 0 in the first year, 500,000 in the second, and then the next depreciation is half of that, or 250. Okay? All right, so any other questions on double declining balance, anything on straight line? Make sure you review all of those methods, units of output. We're going to do units of output again when we look at depletion. Yeah, last question?
I was going to say, so for the next year, you don't have to do, but is the cost still going to be 1 million, and then you're
Yeah, cost is 1 million, and the accumulated would be 750, right? Because now you're taking, so Amir's question is, if you take half of this now, your depreciation in year 2, year 2 depreciation is 250. So what's happening is if you look at the accumulated depreciation at the end of year 1, this is the end of year 1, was 500,000. And then year 2, you added 250. So the accumulated, this is the end, and I'll move this up in a second, of year 2, but it's the beginning of year 3. So that's the way it would work. And then, of course, the cost stays at $1 million. The cost doesn't change. All right, any other questions? All right, let's move to the next issue, and that is going to be accounting for disposals. Plant assets will be sold, scrapped, when their usefulness to the company is no longer as great as once thought. So you may need to upgrade an asset. Your asset may become obsolete. It may become to the point where it is damaged, can no longer be used effectively in production. So when an asset is sold, here's the most important thing. Don't forget, just like a write-off of a bad debt, when you write off a bad debt, we did this during office hours today, what do you remove? You have to remove the receivable and the allowance. You have to remove the contra account and the asset account. The same thing is true here. When you sell an asset, when you dispose of an asset, you have to remove its cost and accumulated depreciation. The other difference now, or I think a complicating factor, is that the depreciation has to be brought up to the date of the disposal. So if you have a 12/31 year end, if your December 31st is your year end, that's the point at which you took depreciation. Then if you sell the asset the following July, your depreciation is not up to date. You would have to take another half year. So you always have to bring the net book value up to the date of the disposal. And the gains and losses, of course, go on the income statement. They would be classified as other revenue or other expenses, as we've seen. Again, keep going back to what we had in the prior chapters. When you look at a multi-step or even a single-step income statement, other revenue, other expense would include items like gains and losses on the disposal of plant assets. Now, the steps I just outlined are, I think, very clear on this next slide. It's a good document to study. The first thing you would do in looking at a disposal is to make sure that the depreciation is up to the date of the sale. Remove the cost and the contra account. So just remember, you always have to remove the net book value of the asset you've sold. Record any cash received, and incidentally, it doesn't have to be cash. You could receive other assets in exchange. And the difference between the book value and the cash received is a gain or loss. Now, the question you had before is if the book value is equal to the scrap value. Let's say it was $5,000 in our other example that we did on Tuesday. If you scrap the asset, just give it away, the loss is $5,000. Because the book value is $5,000 and the assets received are $0. So that could happen. And that's going to be our first example. All right, so those are the steps. So now let's take a look at example 1. I've added a few examples here for you. The first one says that we're going to retire the asset. We're not going to sell it, we're just going to scrap it. No cash received, no assets received. So it's no longer used by the company, and therefore they're going to simply scrap the asset. The asset had a cost of $10,000, and the accumulated depreciation on the asset is also $10,000. So therefore, its book value is 0. This is the simple case. If the book value is 0, there would be no gain or loss. Right? So if the book value is 0, there is no gain or loss. Now let me remind you again what that book value looks like. So in this case, the asset let's say it's equipment, and that's probably what it is in this case. and you have accumulated depreciation. This is the cost of the asset, and the accumulated is $10,000. On the day they scrap the asset, the net book value is equal to 0. All right, so the net book value is 0. So when they sell it, there's no gain. When they dispose of it, there's no gain or loss. It has a 0 value. Now, to go back to one of the first questions we had this afternoon was, could you use an asset if it's fully depreciated? Do you have to write off the scrap value? No. And you can continue to use that asset for another 5 or 10 or 15 years. That's the issue that we face in accounting, is the use of estimates. So sometimes we overestimate and sometimes we underestimate. Now this may seem very dramatic and like you're providing incorrect information, but for a company with thousands of assets, some of them are over-depreciated, others are under-depreciated, so on average, you're going to show a fair presentation. So in this case, the asset has a 0 value, and we're going to scrap it. So when we look at the entry, it simply debits the accumulated account and credits the equipment. It takes it off the books. Okay, so we debit the accumulated depreciation and we credit the equipment. So if we go back to the T accounts, the entry to scrap this asset would debit the accumulated, brings that asset to 0, and of course would credit the equipment account. So you have to remove the net book value. The net book value of the asset has to be removed. Now, any questions in this particular case? So this is the base case or the foundation. Let's go to the next one. Here's the next example. Same asset. But unlike the previous case, it's not fully depreciated. And we're going to sell the asset on July 1. So the problem we're going to face this time, and I'm just going to put some dates up here, and probably this is a very common scenario. So on December 31st, you took a depreciation adjustment. Let's say that's 2013. 2014 begins, of course, on January 1. On July 1, we have a disposal. The problem is the last time we took depreciation was here. So we need to depreciate for another half a year. So we have to make sure that the asset account is up to date. Now, I'm going to put some numbers in a second. And again, realize that the next time you take depreciation is December 31 out here. So that's the model that we're looking at. The last time, and you always assume the last time they take depreciation is the end of the year. You can't assume otherwise unless you're told. And then we sell it on July 1, but we failed to update our accounts because we don't expect to make an adjustment until when? Next December. So now let's take a look at the numbers. Sorry about that. The numbers they give you in the problem. We have this asset with a $10,000 cost, and we depreciated it $8,000. So they're telling you the straight line method was used with no scrap value, so it was $1,000 per year. They're giving you that information. So obviously you depreciated the asset for 8 years. So the way the accounts would look, and you're just going to scrap the asset, no cash involved. So the way the asset account would look, or the way the asset accounts would appear, just move this down a little bit, is that you have this asset or this equipment account for $10,000, and you have the accumulated depreciation on that account. So you took $1,000 for each year. I'm just going to fast forward to year 8. So at this point, you've written off $8,000. And now we're going to dispose or scrap the asset. But before we do that, the last time we took depreciation was at the end of year 8. Now we're in year 9 or 2014, and we have to bring it up to date. So in other words, we would have to think about the depreciation for the year, which would be $1,000, and we need to take another half to bring the account up to date. So the correct amount in here has to be $500 more, or $8,500. So the correct amount of depreciation has to be $8,500. And therefore, you would have to take an adjustment at July 1, which debits depreciation expense and credits the accumulated. So you have to bring the asset up to the date of the disposal. So if you're taking $1,000 for the year, but you're selling the asset or disposing the asset on July 1, you have to take half of that at that point. So the correct amount of accumulated depreciation that should be reported at the point of sale is $8,500. And the net book value on the date of the sale, so if you look at the net book value, it should be $1,500. You have cost of 10 and accumulated of 85. So the asset has a book value of $1,500. If you sell it for more than 15, it's a gain. If you sell it for less than 15, it's a loss. And if you scrap it, obviously for nothing, you're going to lose $1,500. And that's what's going to happen in this case. We're just going to scrap the asset with no cash flow, without any assets coming in. So any questions about the scenario that's being presented with respect to this asset? All right, let's see if we can make the entry. So again, there's no cash involved. And obviously you have to take, and they're doing it by month, half a year. So we need to record half a year's depreciation of $500. We've got to bring the accumulated up to 85. The journal entry you'd have to make, and notice the date is July 1. So normally you would make the entry on when? December 31st, but we're making this entry on July 1. It's a mid-year sale, a mid-year disposal, and therefore we have to make the entry at that point. And then when we sell the asset, remember we have to remove the cost and the accumulated up to the date of the sale. So let me go back to the T accounts. And the journal entry to sell this asset will require that I debit the accumulated account for its balance. That account has to go. If the asset is sold, then it's related, and again, this would be equipment, obviously. We'd have to identify it by the type of asset the contra account relates to. You'd have to debit accumulated for 85 to make it 0, and credit the equipment 10,000 to make that 0. So the next entry we're going to see, which I'll put up right now, is going to be the entry to sell it. And the entry on the sale debits the accumulated account, and that makes that account 0. It credits the equipment to make the account 0, and since you did not receive any assets in exchange, no cash or no assets in exchange, you have a loss of 15. So if you scrap it for no consideration, nothing comes in, you have to record the loss. All right, so for example 2, the loss on the exchange. And the loss on the exchange is always calculated by the assets received versus the amount of the book value. Now, any questions on the entry before I explain or at least think about that loss? That loss goes into other revenues and other expenses. So now, when you calculate the gain or loss on this transaction, you have to look at the selling price, which is cash or other assets received, against the net book value. So in this case, you received no assets in exchange. The net book value is subtracted, and the loss is 15. So the loss is 15. Now again, the net book value, just remember, the toughest thing I know early on, especially you're in like a couple of months, it's still tough. Definitions. So net book value is cost minus accumulated depreciation. Cost minus accumulated. Any questions on the second example? We have one more to go, but any questions on the second illustration? Yeah, I mean.
It wasn't like the middle of the month, but here's the 360 days.
Yeah, if it was, we will probably see this in some cases. We didn't do it in depreciation, but the question is, what if it's in the middle of the month? And some companies have, for instance, we have a nice clean, July 1. So what if we sold the asset on July 7 or July 15th or something like that? You could do it by days. A lot of companies have simplifying rules, and they would say if anything happens in 1 month, if it's in the first half of the month, assume it happened at the beginning. If it's in the last half, assume it's at the end. But you're right, you'd have to prorate it exactly by the number of days. No. Okay, there's another good question. Is the net book value the same as the residual value? No, that's only true if the asset is fully depreciated. So once you depreciate the asset for, let's say it's a 10-year asset and it's got a $3,000 scrap, if you depreciate it down to $3,000, that's the only time the residual and the net book value are the same. And I think I mentioned this on with respect to the couple of the tables we looked at. So let me go back and put that up again if I can find them, if I brought them with me. Yeah. Okay. So if we look at even taking a simple, let's take a simple straight line depreciation. The net book value is always cost minus accumulated. So the question is, what's the difference between net book value and scrap value? In this particular example, the asset had a $5,000 scrap value. That only appears when the asset is fully depreciated. So all the way through, the asset's cost is $125, but you depreciated it $24,000 in the first year. It gives you a net book value of $101. If you depreciated another $24, because it's straight line, and there's your depreciation expense right here. If you depreciated another $24,000, your accumulated is 48 rather, and your net book value is 77. So the net book value is not the same as the scrap value unless you're at the end of the asset's life. And in this example, it said the scrap value was 0. So if you held that asset for 10 years, it would have a 0 scrap value. And that would be its book value at the same time. In fact, that is also, if you remember our first example, in the first scenario, the asset was fully depreciated. So its book value was 0, and that also was its scrap value. But that's only at the end of the asset's life. Right. Any other questions? All right, we have one more example on disposals. So in our third example, we're going to assume that the company received $4,000 in cash. So now they sell that same asset for $4,000, and once again, it's the same scenario. Right? You don't have to draw it out again. You got the same scenario. You got the equipment that cost $10,000. You had $1,000 per year. You depreciated it for $1,000 per year for 8 years. So you had an $8,000 accumulated depreciation. So it looked, again, like this. It was the same scenario where we depreciated it at 8. You also need another half year, so we have to take another 500. So the accumulated goes to 85. So let me put it back up on the screen. So it's the same story. You have to depreciate it for 6 more months. You have to make the entry that brings the depreciation up to the date of the sale. And then you have to record the gain or loss on disposal. Now in this case, you're going to receive $4,000 in cash. The $4,000 in cash is going to be compared to the book value of 15, and as a result, you would have a gain in this case of 2,500. So you'd have a gain of 2,500. And the entry, I should say the computation, is pretty much what I said before. Cash proceeds minus the net book value. And the gain is 2,500. And the journal entry debits cash, removes the net book value. Remember, you always have to remove the net book value by debiting accumulated and crediting the equipment, and then you record the gain. So once again, we bring those accounts up. It's really the same, exactly the same scenario where you have to debit the accumulated account to bring that to zero, 8,500, and you have to credit the equipment for 8,500. So in this case, you received 4,000 on an asset with a net book value of 15, and the gain is 2,500. The gain becomes part of other revenues and other expenses on your income statement. Yeah, question.
What kind of account is loss on disposal?
Loss on disposal is a type of, if you remember, we looked at expenses in general, and we said that you had expenses and losses, and when we look at revenues in general, we have revenues and gains. The gains and losses come from peripheral activities, activities outside your normal course of business. So a good way to think of a loss is an expense incurred in activities outside of your normal operations. So the loss in this case is due to a sale of an asset that is not part of Smart Touch Learning. They do consulting, and they also sell digital devices, and that's their business. Their business is not to sell equipment. Anyone with any other questions? Any other questions on gains and losses on disposal? All right. Let's go to a couple of questions then. Now again, this is just like, 15 minutes, so let's see how much you
Quick question.
remember. Yeah, I'm going to put it up, yes.
There is nothing.
Hold down for a second, I can't hear the question, yes.
The residual value is the same as accumulated.
Residual value
Yes, the same thing, right? Because
as scrap value?
residual value, wait, the residual value is the leftover value, right?
Yes, at the end of the asset's life. Right. Okay. So let's go to a question. So let's take the first one. When a business sells a plant asset for book value, a gain or loss should be recorded? Yes? No. It's the same as net book value. Right, book value is the same as net book value. Book value is the same as net book value. Whoa! Man! Okay. Nose up. Call it quits here, I think. All right. Here's the problem. One of the unfortunate things in accounting, you have to read the questions like carefully. So when they sell a gain, well, yeah, I mean, I guess let's see what it says here. When a business sells a plant asset for book value, if you sell it for book value, could you have a gain or a loss? No. Right. There's no gain or loss. Right. So it's false. Right. Now, that's like, here, that's like in this case, and I really need to go over this again because we have half the class with the wrong answer, so that part of that could be that, you just kind of press anything, but if you really didn't understand it, if I sell this asset for $1,500, what's my gain or loss? Nothing. Nothing. So if it is sold for book value, you cannot have a gain or loss. You cannot have a gain or loss. All right, so let's try another one. I was going to skip this one, but I better not. All right. Asset is fully depreciated when? What happened? Oh, I know. Thank you. Okay. There we go. All right. All right, so that was good. Let's see. It's a good one. Oops, sorry about that. It's pretty big, right? All right, so let's see. When an asset is fully depreciated, it would be equal to its residual value. Said that about maybe 7 minutes ago, that even if the residual value is 0, that's what's left when you fully depreciate it. Okay. All right, let's go to one more. And want to take a look at the last two. Okay. All right, this one, yeah, equipment, and I'll give you some cheat time here. Equipment was purchased for $24,000. It has an estimated life of 5 years, and its residual value is 4. Straight line method is used. It is sold for $18,000 at the end of the first year. Is that the correct entry, true or false? Now, if this was the exam, I'd give you 4 different entries to pick, but just want to make this quick. So is this the correct entry? Oh, that would help. You're going to leave me standing here all day, right? Thanks. I'm falling asleep. I get bored myself. Okay. Yes. What about it? Yeah, I'll talk to you about it. I did. Okay. All right. Before I do anything, let's look at the scenario here. All right. Okay. So let's look at this. It tells you equipment's purchased for 24, and the residual value is 4,000, so that it's straight line. 24, right? 24 minus 4 over 5. This is the depreciable cost of 20, and that means you're going to depreciate it $4,000 per year. So at this point, this was what? Equipment. The equipment is 24, and the accumulated depreciation is 4. So the net book value is 20. Net book value is 20. Selling price was 18, and the net book value was 20. So the loss on sale is 2. And bring that in a little bit so you can see it. All right, so the loss on sale is 2,000. Loss on sale is 2,000. So if you debited cash for the amount you received, that is correct. If you debit accumulated for the 4,000, that is correct. If you debit the loss for 2, that's correct, and then credit the asset for 24. So the answer is true. The answer is true. Okay. All right, now, this last one. Yes, sorry about that. Okay. Now, this last one I'm not going to do. It's the same problem, right? I think it's the same problem. Let's see, it's the same one. Yeah, it has the same net book value, right? Same net book value. If you sell it for 25, in this case, and the entry shows a loss, does it make any sense? Well, let's see. It's the same problem. And I'm not going to ask you to do this one, but if you sell it for 25 rather than 18 this time, instead of having a loss on sale, you have a gain, and that gain is 5. So that the answer to that one is false. Yeah, it has this, everything else is the same, but the answer is false. There's no loss in that case, there's a gain. All right, so good examples, and again, people are asking me for samples. I don't know if you ever played with the My Accounting Lab aside from the stuff you have to do, but they have a lot of pre and post tests on there. There's a lot of good things you can look at, and of course you look at these questions as well. All right, so that's it for disposals. Now, the last 2 topics for this chapter will be intangible assets and natural resources, and these are very much like plant and equipment it operates the same way with a couple of differences. Of course, natural resources are another type of long-term asset. And the difference, of course, is that with natural resources, you'll find that sometimes they sell the products directly. In other cases, they use them in production. So I know a lot of you, I think one person here took the geology course. If you take a geology course here, they send you to a gypsum mine in Roseland. One of my clients would make sheetrock or wallboard, all that, you see when there's new construction. And they would actually have their own gypsum mine. They would mine the gypsum, put it on barges down Delaware River somewhere in Philly. They would, make the wallboard. So in that case, the natural resource was generating inventory of supplies. If you sell it to someone else, obviously, it's going to be inventory that is sold like merchandise inventory. Now, they're long-term assets, and again, we have to think about whether or not we're going to write these off. The long-term assets include, as I said, iron ore, natural gas, coal, timber, any other type of minerals that could be extracted. Now, when we look at the company's valuation, they generally value it at cost, and that cost is based on reserves that they expect. So when you have, let's say you buy a offshore piece, or at least you're designated an offshore drilling rights, you have to estimate how many barrels of oil you think you're going to get from that, and that becomes what you'd be willing to pay, or at least part of what you'd be willing to pay. Same thing for any other type of deposit. We're going to write the asset down. Instead of calling it depreciation, we're going to call it depletion. Now, it's exactly the same as depreciation, but it is called depletion. We use a different term. Depletion is the same concept in that it is a systematic write-off of the cost of a natural resource. It's exactly the same in concept. So we would use the depletion expense rather than depreciation expense. And again, on the exam, watch the language like really carefully. Make sure you don't use depreciation when you have a natural resource. It's got to be depletion. And there's a contra asset, which is known as the accumulated depletion, and it operates the same way. Now, the most commonly used method that we have for natural resources is going to be the units of output. So the units of output method is the most commonly used approach that we use for depletion of natural resources. So let me go right to an example. And you know the adjusting entry obviously has to be a debit to depletion expense and a credit to accumulated depletion. It operates the same way. So here's an example. And this is also the same, and that's why I didn't do much on units of output depreciation, because we knew we were going to cover units of output depletion. Units of output depletion, in this case, would operate where you would come up with a rate of depletion per unit produced. So in the examples we gave you, we had a rate per mile driven or a rate per units of output. This could be the rate for tons of gypsum or coal, or barrels of barrels of oil, cubic feet of natural gas. That would be the units that you would use. So in this case, you have an asset that cost you $700,000. There are 70,000 barrels of oil expected, and during the year, 3,000 are extracted. When we use the units of output approach, you have to come up with a rate of depletion per unit produced. And it looks very much like straight line. It takes the depreciable cost and divides it by the useful life. But the useful life, as I explained, is not in years, it is in output. So even if I told you that this deposit was going to last for 40 years, it doesn't matter. Once you extract 70,000 barrels, it is completely depreciated. You stop or deplete it, it's completely depleted at that point. So in this case, it's cost minus the residual, and in this case, the residual value was 0, and they have 70,000 barrels, so it's 10,000 barrels per year. If you extracted 3,000 barrels, then of course your depletion expense is going to be the 30,000. and the entry would be exactly the same, except that the accounts are different as depreciation. So you have a debit to depletion expense and a credit to accumulated depletion. Exactly the same process. And again, and I had this during office hours today, someone asked me to compare the two, so I'll do that for you as well. It looks very much like straight line, so let me try to make this clear. If you have straight line depreciation, you're going to have the cost minus the estimated scrap value over the estimated life, and that gives you depreciation expense, and this is in years, per year. So that's the amount of depreciation expense. If you're using units of output, it looks the same because it starts with depreciable cost. But now it's estimated units of output. So that gives you a rate of, in this case, let's call it depletion per unit produced. So although it uses a same or a similar structure with the depreciable cost divided by some measure of life or usefulness, in this case, you get a rate of depletion per unit. And the only way you can get depletion expense is if you take the rate of depletion per unit and you multiply that by the units produced. All right, so that's the difference. So you have to go through an extra step to get the depletion. So you have to go through an extra step. You have to get the rate per unit and then know the units produced. Those are the actual units produced. There's no estimate in there.
Scrap value always zero?
No, not necessarily. But the question is the scrap value always zero for natural resources? It could be given to you that it's a positive scrap value, but in reality, it has a negative scrap value. Right? So if you have, we talked about that, if you have natural resources, and you go in and do some mining for whenever, let's say that Roseland quarry, that Roseland quarry might be fully, all the reserves will be out of there, let's say in 10 years. The owner of that business is responsible to reclaim the land, so there's a negative scrap value. So in higher level accounting courses, we account for that. On the day you buy an asset, you are required to prepare for the reclamation cost. You accrue that cost in the year you buy the asset. You actually put it in the cost of the asset and you deplete it. So that's a real good question. There's no scrap value. Typically, if there's anything, there's a negative scrap value on natural resources. Okay. All right, any other questions? All right. People walking out, they don't like, I guess, natural resources. Okay. All right, so we got a few leave early before. I guess they didn't like depreciation either. All right, so we have one more example. Amplified Petroleum holds reserves of oil estimated to be 100 million, and the cost of those reserves is $80 million, and it sells 20 million barrels in 2015. So let's see just to give you another example, what you would have to do is, let me go back up, sorry about that. The estimation is the 80 million. So in this case, the cost is 80 million. We put this in millions. The estimated scrap value here is 0, and there's 100 million barrels of oil estimated in this example. So therefore, the rate is 80 cents, and the depletion expense in this example is 80 cents multiplied by the units produced, and in that case, it would be the 20 million. So the depletion is 16 million. So exactly what we said before, if you take the cost minus the scrap value, in this case the depletion rate is 80 cents per unit, and if you produce 20 million units, your depletion is 16 million. So the entry that you'd have to make would be to debit the depletion expense and credit the accumulated depletion. All right, now, I'm not going to ask any questions on this one. Nah, they're pretty simple. But the two in the back, I mean, if you want, I mean, obviously this is false. I said it 6 times. It's depletion. This is false. It's depletion. If you want the answer to this one, we just did a similar question. It's D. Let me go back. Okay. So the answer to this one is D. All right. Hopefully everyone likes intangibles. Last topic, and please, as I said, with the 3 minutes to go, this is on the exam, so if you want to leave, just kind of sit, hold a chair, and wait. So I don't want to disturb everybody. All right, so intangible assets. The last type of intangible is a long-lived asset. It also has no physical substance, but it has value because of the rights that it confers on the holder. So intangibles, again, they have it's not physical, it's not a brick and mortar type of asset, but it has no physical substance, but the value is the rights that it confers on the holder. Examples would be patents, copyrights, trademarks, franchise agreements, and the like. Now, one important point on this next slide is that when you look at what gets included, patents, copyrights, trademarks, licenses, goodwill, we'll talk a little bit about each one of those, and you're not going to be responsible to know that a patent is 20 years and a copyright is 28 years plus the life of the holder of the copyright. Franchise agreements could be any number of years. You could sign a 10-year agreement to sell McDonald's on a franchise. Not worried about that, worry more about the concept. The big issue for me here is research and development. Research and development, make sure you know this, are expenses. So companies and remember we put Apple's financial statements up on the screen. Apple spends billions every year in research. It is not considered an asset. It is expense immediately. It hits their bottom line instantly. Johnson & Johnson, any heavy research company. Now you might think that doesn't make sense, and it's only done because of the inability of accountants and analysts to determine whether or not the projects will be successful. So when Apple is pumping money, and they put lots of money into this telephone thing that I guess Samsung has now or somebody else has, and they also had a car. They were going to develop their own car. So all of that research, how do we know just because Apple was doing something that it's going to be successful? So because we cannot predict the future marketability of the product, we expense research and development. But clearly, it's disclosed. It was, if you remember the Apple income statement, it was the first expense that you saw. Why? Because the reader of the financial statements, the market analyst, sees that as an asset. It sees it as an asset for the company. So if you spend billions on research, the market views that as favorable, even though it lowers your income. So research expenditures are going to be expense. They're not assets. Now, we also have to remember that we have two types of intangibles. Some intangibles will lose value, others are tied to the entity as a whole. So let me summarize this for you. So you have two types of intangibles. You have finite or definite life, and the second type are indefinite life intangibles. Finite life intangibles have a fixed period. So patents would be 20 years, or the economic life of a patent might be 3 years. You have indefinite life intangibles. Those intangibles could last as long as the business, so that we will write them down, and the term that we use is amortization. So that if you have a definite life intangible, it is amortized. Amortization is the word we use, or the term we use to write down intangibles. So just remember, depreciation, plant assets. Depletion, natural resources. Amortization, intangible assets. And in many cases, if you go into finance, you call that DDA, depreciation, depletion, amortization. It's all the same, has the same effect, but it's a different term for each. So an example here would be a franchise. And an example here would be something called Goodwill. And you would write this off. When you do amortize, you amortize over the economic life or the legal life, whichever is shorter. So for example, if you had a franchise to sell a product, and that franchise was 10 years, but the demand for that product is starting to drop, and you are advised that your company could probably only survive 3 years, the economic life is 3 years, although the franchise lasts for 10, you write it off over the shorter of the two. I'll put that up on the PowerPoints in a second. Goodwill does not get amortized because it is tied to the life of the business. Goodwill is something that is created when a company is purchased. So in a merger or an acquisition, that's when goodwill arises. So goodwill can only come about if the business is purchased in a merger. You can't create your own goodwill. So basically, what happens is that if your company has net assets, assets minus liabilities worth, let's say, $100 million, and someone's willing to pay $200 million for that business, we rule out stupidity, right? We say, well, you're not going to pay an extra $100 million for this business for no reason. There are lots of reasons for it. It could be customer reputation, quality reputation, customer following. It could be the location. All of that is wrapped into the goodwill. So the goodwill is the excess that you pay for a company. And that is only going to arise in mergers and acquisitions. It's only going to arise in mergers and acquisitions. So now, just to summarize, this is all, you find all of this in the PowerPoint. So again, only definite life intangibles are amortized. Let me just fast forward here. Just one point, and this, by the way, this doesn't really bother me, but to answer the homework and everything else, you have to know this. You could use an accumulated amortization account. You could, but typically we don't. So the intangible is credited directly. I'm going to show you an example in a second. So you don't use a contra account as a rule for intangibles. You typically don't use a contra account for intangibles. And I would also recommend that you look at this table. You don't have to, again, you don't have to memorize the years of copyrights or patents, but I would make sure I know what is a indefinite life intangible and what is a definite life. The first three are definite life intangibles. They get amortized. Goodwill and trademarks or trade names are indefinite life. For example, Nike, the Nike swoosh logo, priceless, right? Priceless. So it lasts as long as Nike lasts. Coca-Cola, the Apple logo, which I sometimes see when people have their computers open. So if you look at that logo, that has value to the company. All right. Now, take an example. Let's do a definite life intangible. And we have Orange Manufacturing pays $40,000 for a patent. It has a legal life of 20 years. And again, it's on the exam. Just hang in. I got 3-4 minutes left. I'm going to do this example with you and say something about Goodwill. So you got $40,000 paid. It has a legal life of 20 years. There is generally no residual, but the expected life is going to be 8 years. In other words, even though you have a legal life of 20 years, economically, it's only going to last 8. Like, what if someone develops a new computer chip today? They have a patent for 20 years. You think someone's not going to come up with a better chip in a year or even 6 months? So technically, it has to be the shorter of the economic or the legal life. So in this case, we're going to use the shorter of the two. And to amortize the patent, it's going to be the $40,000 divided by 8. And just notice the difference, that you would debit the amortization expense and you credit the patent account directly. So just make sure, again, it wouldn't bother me if this was a type of exam where you can write your answer out. If you credited accumulated amortization, it would not bother me. But again, for homework and the textbook, you have to use that approach. Okay? All right, now the last thing I just want to talk to you about is Goodwill, and then we'll wrap it up. Just make sure you understand what Goodwill represents. But I want you to understand that even though, hold it down, even though that these are the factors, that relate to Goodwill, again, Goodwill is not amortized. Of course, any asset could be impaired. Goodwill is not amortized. Although these are the factors that relate to Goodwill, that is not the way Goodwill is calculated. Goodwill is calculated by looking at the excess of what you pay over the fair value of the company's net assets. So let's take an example. Now again, Goodwill is not, so if I ask the question on the exam, and I asked you what Goodwill is, and if you say it's because customers like the company or they have a quality product, you're wrong. Unless I ask it, what are the factors that could contribute to Goodwill? Goodwill is an excess payment. So if you look at this company, BC Products has 100% of Aiden Associates. And again, this is on the test. I don't know, if you don't really worry, this is on there, come on. So I want to make sure that you can answer this question. So if you paid for 100% of Aiden Associates and they paid $800,000 in cash, Aiden's assets have a fair market value of $2 million and its liabilities are $1.4 million. What is the amount of the Goodwill? Goodwill is the excess of your cost over the fair value of the business that you buy. So the business is appraised at what? Assets minus liabilities. The business is appraised at $600,000. You paid $800,000. The excess goes into an intangible asset that's called Goodwill. Goodwill is not amortized because it survives as long as the life of the business. So If anybody buys, if you look at mergers, like right now, if somebody buys BlackBerry, I think Google was actually negotiating. If Google buys BlackBerry, they may have goodwill, they may actually have negative goodwill, but let's say they have goodwill. If they pay more than the fair value of the net assets of BlackBerry, it would create goodwill, and that goes on the balance sheet as a long-term asset. Okay. Now, I will look at the quiz again. There is a quiz for 9, but I'm going to give you extended time or infinite tries just to study from that.